So my name's Stuart Thompson, and I'm the Executive Director for the Good Business Foundation, or the GBF as we like to call it. At the GBF, our thesis is simple. Good business equals good lives. We have a focus on supporting the small and medium business sector in emerging markets and communities. The GBF is proud to be partnering with AIDN on this three-part webinar series addressing global issues. AIDN's message is simple: more embedded giving and investing from Australia to international development. One of the ways AIDN is going about this is by showcasing and amplifying the work and issues in the sector. I'd like to start today by acknowledging the traditional lands on which we are all tuning in from today. I'm on Wadawurrung country, and I'd like to pay my respects to their elders past, present and emerging. I would also like to thank and acknowledge our Indigenous brothers and sisters for the care they've had for this land over millennia and for giving us the foundations of how to do good business. Today we have a pretty exciting lineup hosted by Claire Hanratty. Claire returned to Australia in early 2021 after 5 years in the UK. She is presently Director of Good Wolf Partners, and whilst in the UK, Claire served as CEO and Director for the Leapfrog Group. Prior to going to England, Claire was CEO and Managing Director of the Great Barrier Reef Foundation, and prior to that, she spent 8 years with Rio Tinto. Claire began her career in finance with BP in New Zealand, Australia, and the UK and Europe. She holds an MBA from INSEAD in France, among other relevant academic qualifications. I think we can all agree we're in great hands today for today's sessions. So over to you, Claire.
Thank you, Stuart. Good morning, everybody. Really pleased to be with you today. I too would like to acknowledge the traditional owners, the Turrbal and Yagara people where I am today, and give my respects to elders past, present and emerging. Today we're going to look at an overview of impact investing, its principles, practices, and look at how it aligns with the opportunities of international and the needs of international development. We're drawing out an example from each of the investor, fund manager, and investee domains that provide an insight for donors in international development. Subsequent sessions will build out more of these opportunities and understanding. I have an amazing panel this morning, and let me just share a slide as I talk you through my panel. So let me bring this up and I can share that with you. Let me just bring this down here and share the slide. So I'm hoping everybody can see that. Give me a nod if that's all okay. So our panel this morning, to introduce Allan English as an investor does him a great injustice. Allan is the Director of the English Family Foundation and World Tree. He has an array of experiences on corporate and philanthropic boards. He's the founder and past non-executive chairman of ATEC and B Corp accredited Silver Chef. There is more on his bio and the bio of each of our panelists in the chat, so I won't go further, but thank you, Allan, for joining us. Simon Miller is playing the role of fund manager this morning. Simon comes from the depths of corporate M&A law to non-profit roles over the last 15 years and in the international NGO space. And in particular, he's sharing with us today his experience and the work that he has been doing in the establishment of an impact investing fund for Save the Children Australia, and how that's playing out subsequently in the international Save the Children space. Ben Jeffries is our investee today. Ben is the CEO of ATEC, which provides PayGo-enabled modern cooking products for base of the pyramid households, addressing the issues of clean cooking. Ben is soon to be moving with his family to Cambodia to set up ATEC, and has a lot of experience that he can share with us around raising impact investment funds. So let me just talk for a moment about impact investing and what it is, if I can get the slide to move. Here we go. So impact investments, as defined by the Global Impact Investing Network, otherwise known as GIN, are investments made with the intention to generate positive, measurable social and environmental impact alongside a financial return. And within that statement, there's some key elements that we want to just unpack. Firstly, is the investor's intention to have a social and environmental impact. So this whole question of intentionality is really key, and it's fundamental to impact investing. So it is that objective that the investor goes in with a particular goal of creating impact. Secondly, impact investments are expected to generate a financial return. So that differentiates them from philanthropy alone. The very minimum an impact investment should have is a return of the capital. And we'll talk a little bit more about this financial return aspect as we go through and in our next slide. In addition, there's an expectation that there are a range of returns and a range of asset classes. So this is not just about equities. This can be debt, this can be cash, this can be a range of venture capital and private equity type models. So I'm just double checking some things here. Sorry, just let me show this chat so that I can just be making sure that I'm covering things off here. So impact investments, there will be those that are below market, sometimes called concessionary or impact first, to a risk-adjusted market rate. There are, as I said, a range of asset classes that applies to. Another key element of impact investing is that there is measurement and monitoring of the impact. And this is fundamental. This is about transparency and accountability so that it is possible for the investors and the investee to track the actual outcomes, those social and environmental outcomes that they're trying to achieve. So those are our core elements of impact investing. Let's just take a moment and look at how they differentiate from traditional philanthropy and traditional investing. So in a traditional philanthropy world, that is us just donating money in line with our charitable objects. And a lot of what we have talked about to date through AIDN really focuses on this traditional philanthropy space. It is, as AIDN speaks of, more and better philanthropy. Traditional investing at the other end of the spectrum simply focuses on a financial return. It looks for market returns, and there is no screening of those investments for either positive or negative impacts. And all, we should say, all investments have a positive or negative impact in some form. Right, just let me. So let us take a look at the other pieces to this picture. So on the right-hand side, we can move from traditional philanthropy through venture philanthropy into what we will call impact first and then subsequently finance first investments. Impact first investments may be those that are concessionary. They are where a donor or an investor in this case is actually investing for the specific purpose of achieving that impact. That is their number one goal. They will trade off returns for the impact outcomes that they are seeking. There is an estimate that that's about 1/3 of the impact investing market globally. By contrast, you have the finance first impact investing market. They deliver market rate returns, but also achieve the specific impact outcomes. So it is helpful to see impact first and finance first as a spectrum, rather than probably as we have described it here now in two separate boxes. There will be a range of outcomes along that spectrum. On the left-hand side here, we move from traditional investing through to responsible investing, which is really about avoiding harm and applying screens to avoid the harm. So for example, avoiding investing in organisations that fund weapons or tobacco and the like. So it screens out. Through sustainable investing, many of you will be very familiar with the terms ESG, or environmental social governance. Those screens and those focuses and that framework tries to bring to the table benefit to society, and therefore the objective is sustainable investing. Impact investments, by contrast, then seek to directly contribute to solutions. So their goal, as I said before, is those impact outcomes. So this is a helpful spectrum for us to understand. And as we speak to each of our panelists today, we're going to unpack where they sit on this right-hand side of the spectrum in particular. Let me then talk for a moment about where impact investing sits in relation to the international development. Many of you will be familiar with what's known as the Sustainable Development Goals, the SDGs, or the Global Goals. These 17 goals were established and agreed through the UN by all 195 countries of the UN in 2015. They have targets and indicators sitting below each of these goals, and very clear objectives to achieve each of them by 2030. Now, what we know is that COVID has had a substantial impact on the objectives of achieving these goals. We know that, for example, in 2020 alone, COVID-19 pushed 20 million people into poverty. In 2021, the World Economic Forum reported that there's an expected $7 trillion a year needed to achieve these global goals by 2030. It is clear on that scale that these cannot alone be funded by governments, and in particular that in emerging markets there are significant opportunities to deploy impact investment funds to help achieve these goals. That's not to say that opportunities are confined to emerging markets, but that they actually there are significant opportunities there, but emerging in other markets as well. Now I'm going to pause there, and I'm going to stop sharing, and I'm going to bring our panelists back, and I'm going to have a wee chat with each of our panelists. Allan, I might like to start with you, if you would be so kind. You've been an impact investor for some time now. Tell us a little bit about how you got involved in impact investing and why you got involved in it.
Sure. Well, my first exposure to impact investing was actually in the Philippines. Through early stages as a philanthropist, I was doing grants to microfinance for women in the developing world to start a small business and work themselves out of poverty. And as the projects became larger, it became clear that attracting further capital was going to be very important for the growth of the microfinance programs. And we started seeing that there was investors who were willing to put capital in because the loan book was now of a certain size that it was financially attractive. And they were coming from a finance first perspective, getting a return. So that was when I started saying, oh, wow, there's actually a way you can do both here. You can actually do the grant making side of it, and you can also have your capital invested in wise areas. Probably about 5 years after that, I got involved in Australia in the Divest Invest project. And that was really started up out of the UK, where they were encouraging foundations to look at their investment strategies to ensure that they matched up with their giving philosophies and ensuring that there was a values alignment. And so we were one of the first foundations in Australia to be actively involved in promoting that concept through the philanthropic world. And it made us look very closely at where we're having our investments, and got rid of some that wasn't quite matching the criteria and invested in others that were.
That's brilliant, Allan. So what role do impact investments for an international development focus play within your portfolio as a whole?
Yeah, certainly. Well, through the microfinance stuff, we've really been very active in building up the infrastructure to enable impact investing to become whole. So in other words, a social entrepreneur or a small business in the developing world, they want to be able to go to the tap and turn it on and know that there's going to be finance coming through or water coming through the tap and the network. We see our role as the foundation is building the plumbing system to enable the water to flow. So we're very actively in system development to be able to build up and scale the size so it can be financially attractive for impact investors to come and play. But we'll also do impact direct ourselves, of course, and a number in Australia, but also in overseas. Probably our largest one that we've done overseas is in an organisation called Liberty University, which is an online educational program that really had a big focus in Sri Lanka to be able to utilise the high school classrooms in the evenings to be able to have post-year 12 students come and do a university degree from home, but get together once a week in the classrooms for that social connection. But as a class, they would then have to develop up a social enterprise which is going to benefit their community. So there's some very big plans about very, very low cost, like $5 a week type cost of education. But COVID played a bit of a role there and slowed that down a bit, but we're certainly hopeful that it'll kick back into life again for the next stage.
Thanks, Allan. That's really interesting. I am going to acknowledge that you're in a cafe, and so it's not possible for you to kind of turn off a couple of comments on the background noise here, but it's not possible for you to completely turn that off. So we really appreciate you joining us regardless. Thank you. I'm going to turn to Simon now. And Simon, Save the Children Australia recently established an impact fund. Tell us a little bit about why you did that.
Yeah, thanks, Claire. Yeah, we opened a fund to wholesale investors in 2020. Probably not the ideal time to be fundraising for a first fund with no track record during a pandemic. But we did manage to achieve $7.5 million of monies for this first fund. We had great support from cornerstone investor QBE Insurance. So we were pretty pleased to get to the start line. We started investing in 2021, and I'll share some more about how we're going during the course of this conversation. I just sort of wanted to note that it is that the way that we've gone about this is a little bit novel. It is the first wholly run commercial fund within a charity, we think, in the world. So we're doing it all ourselves. We don't have a financial intermediary working with us. So that's had some challenges, but also some great benefits. But as to why did we get into this space? There's probably a wash of things. And I'll try and capture them in a couple or in a few categories. A broad feeling, something a bit more specific, and then something a bit philosophical. On the feeling side, we're becoming ever more conscious of the volume of capital that was being directed to impact investing. And there was this buzz and swirl of activity in and around us, but we were not active participants. Impact investing might happen to us or happen to a social enterprise adjacent to us, but we didn't really have any control or we were not an active participant, which really felt strange and a bit alienating, given that social impact is what we'd been doing for 100 years. And there was this thing that was supposed to be half impact and we weren't even at the table. So we didn't like it. We thought, and we still think and are showing that we have something legitimate to contribute. But the first thing was probably this great sense of FOMO. We're not involved, we want to be part of this. So having sort of used FOMO as a great, as an initiator, there's also some real specifics. So Claire, you mentioned the gap in achieving the SDGs. Traditional grant funding models are not going to get anywhere close to that. So how are we, Save the Children, reacting to that? Are we part of the broader solution? we thought at the time we weren't particularly well placed to be part of that the equation beyond the grant funding. So again, another reason to go into the impact investing space. Plus, we were just seeing more opportunities and pipeline either coming through Save the Children from colleagues around the world, being generated by us, and things that we were seeing around our programming. So how could we activate this? So that's sort of the more specific. And going a bit philosophical, and looking at what's the purpose of an organisation like Save the Children. We're set up to have impact and to do things for the benefit of vulnerable children. Our foundations were from a pretty radical place. The founder of Save the Children was arrested in Trafalgar Square for protesting against the Allied blockade in World War I and the starvation of kids that was happening on the other side. When she was found guilty of the charge, and the judge paid her fine, and that became the first contribution to Save the Children. So she was fearless, she was radical. We don't want to be just sitting in our box and be timid and not taking the chances to find the new ways that we can have impact in the world. So that's sort of another reason, being true to our purpose. And our purpose in 2022 and the way we go about achieving that has shifted over time, and we think there's opportunity for us to be doing more for kids and finding new ways for impact. That's a little long, but there's some really deep, sort of a deep basis for us to really go into this new space, which we're still exploring.
Thanks, Simon. I think that's really helpful for us to understand. Tell us a little bit about what kinds of projects the fund will invest in. Is it debt? Is it equity? Is it international? Is it Australian? Where does that sit? And you might want to also introduce here for us the project you're working on with your colleagues internationally too.
Yeah, thanks, Claire. All of this has been a bit of an exploration. In our information memorandum, we had set some targets around equity, debt type splits. As it's played out so far, predominantly we have made equity investments, but we think that there will be more debt and loan type investments that we make in future, particularly as we develop out a broader strata of funding vehicles across the Save the Children movement. So at the moment, we have a particular fund which has it's a commercial fund, and it's got certain parameters. We have some risk constraints that are built into that fund. I think what we are developing with our colleagues globally is an impact investment endowment, which will be built from donated funds, and those funds will be invested and recycled back through this fund. We'll have a bit more space for earlier stage investments through that vehicle, and we expect probably some more loan and debt type support from that fund. But the things that we've invested in so far, we're actually really excited about how this is going. Our first investment was in an independent school in South Australia that was set up to bring along new ways of working with Aboriginal kids. We invested as a syndicate, that is a loan. We're pleased to have a bit of value add beyond our economic contribution. worked with the school on some child safeguarding matters. We've also helped with introductions to government, and we've had the Premier of the state visit the school and get some traction around this type of model. Our next investment, which was our first equity investment, is in an education technology platform, providing high quality education materials for teachers. That particular investment was already fully subscribed, but the founder really wanted Save the Children in as a strategic investor. Again, this was great validity to our involvement in the space. We have been working with that company to help them to, in fact, secure a grant to get their materials out to remote communities and lower socioeconomic groups. And the plan is to extend internationally into environments like refugee camps where, Save the Children provides education services. We've invested in a data science company that helps with fundraising. Save the Children uses it. We're sharing it with our peer charities. It's a great product, helps to get more money into the sector. One that I'm particularly excited about, again, another equity investment. It's a US company. We invested with Save the Children US, our sister organisation. It's a health tech product which is used by community health workers, and it's a diagnostic product in the hands of community health workers that literally saves lives. Because of our engagement with this company as an investor, we've actually come to a new arrangement where we're looking at national level implementation of the product rather than project by project implementation. So the idea that we can bring scale through our investments is really taking shape. So it's a bit exciting. It's new, but it seems to be working.
Thanks, Simon. That's really interesting, just to get a little insight into some of those investments as well. Ben, I'd really like to bring you in here. Tell us a little bit more about ATEC. What got you started in that space, and what role does impact investment play in ATEC's capital structure?
Yeah, thanks, Claire. So, sort of why do we exist as such? I think is a good place to sort of start. So, and it kind of comes back to two fundamental problems that we identified that gets me out of bed in the morning, which is number one, that still half the world's population cook with wood, around 4 billion people per year. So there's this huge problem of people cooking with something that's highly inefficient, and it's actually the leading cause of premature death for women globally, which is not a well-known fact. So that's sort of reason number one. And reason number two, that's probably even a little bit less well-known, is that cooking with biomass actually emits more greenhouse gas emissions than the global airline industry globally. So it's this huge environmental and social problem. It's around 1 gigaton per year from cooking with biomass. So ATEC exists to effectively solve these problems, and those two problems coming together of solving clean cooking and decarbonising it at the same time is actually an opportunity that works very well together, because you can leverage the impact achieved in one to then sort of fund and scale and drive the other as well. So we look to solve this problem through basically sort of what you call tier 5 or high quality cooking solutions for those households around the world, predominantly in Asia and Africa is where we work. So we have two products. We have our original product, which we kicked off in 2016 in Cambodia, which is a biogas system that converts waste into gas and fertilizer, and that'll offset between 4 to 12 tons of greenhouse gas emissions per year, depending on the size. And then recently, we've also launched an electric cooking product range, which is high efficiency magnetic induction cooking, which is very much a sort of what we see as the ultimate solution for cooking globally. It's the most scalable, it's the safest, it's the cheapest solution. It's very much following the multi-billion-dollar investment in most developing countries in grid electrification across the world as well. So they're the two products that we have in the market, and we're expanding quite quickly across Cambodia and Bangladesh, where we currently have 60 staff working in those countries, and looking out to new markets such as Nepal, which is 100% renewable grid, and into Africa, countries like Rwanda, Zambia, Kenya, with these products as well. So for us, the role that capital plays or impact investment plays in ATEC's work is twofold. Number one, we are a startup and a high growth company. So being able to bring on equity investors is really important for us to be able to share our vision and want to fund that growth into the long term. So yeah, we've done 2 seed rounds and a convertible note bridging round, raised about just a bit over about $3.5 million US so far across those rounds. And we're looking to do in a range of 7 to 10 million US equity round in the second half of this year as well. And then on the other side, as you mentioned earlier, Claire, our products are PAYGO integrated. So they're basically data connected stoves. We use that for the carbon credits. That also opens up installment plans for customers as well. And then to underwrite or fund those installment plans, we raise debt financing to cover that. So we've done about $1 million US in debt to date, and we're raising about $5 million US at the moment in debt to effectively underwrite those payment plans for customers as well.
Fascinating, Ben. Thank you. This is probably a good point to ask you in terms of, do you see, if we go back to this finance first, impact first bucket, and let me call it a spectrum rather than buckets, where do you trade off return in your funding, or are you actually fully market rate?
Yes, I mean, it's an interesting question. I think very much on the project side or the enterprise side, we want to have that trade-off. On the investment side, we see a bit of a mix. Some are happy to look at trade-off. Some are like, well, no, we want it to be at the same commercial rates. If I talk on the equity side, I mean, typically a VC would be looking at a 30 to 40% rate of return. Looks like most impact investors, there's a blend there, but some are happy in that 15 to 20% range, sort of annualized internal rate of return, up to that 30 to 40%, depending on who they are. So I think there is a trade-off there from an equity perspective. I think just as important as rate of return is also patience, and there's quite often a lot of talk about patient capital, and I think that's really important. I quite often say that the markets we're working in, if it was commercially viable just to go in and fix whatever problem we're trying to solve, it would have already been solved. So there is often constraints in the market, which is why social enterprise exist in those situations. So yeah, but what we're hoping to see, particularly with the monetization, let's call it, of the value being created in these markets. So that's an abstract way of saying we're now pricing in the environmental impact through carbon credits. What was probably traditionally a very hard market to achieve commercial returns in is suddenly becoming a much more viable. Solving the clean cooking problem is about a $24 billion global market opportunity. But then the carbon credits over 10 years could be up to around $160 billion market opportunity. So you're looking at potentially a 5x higher market on the carbon credits, which kind of quantifies in the market value of the value that's being created in that situation. So I think there is a bit of a mix, and I've talked to a lot of investors, and it's the same on the debt side. There's a whole range anywhere on the debt side from 4% to 16% expected returns, depending on who you're talking to. But typically, we see most people are happy to be a bit more sort of in that 4 to 8% range. So.
Okay, thanks, Ben. That's really interesting. Simon, if I bring you in here, where would you see yourselves on that spectrum of finance to impact?
Yeah, we've been pretty forthright in promoting an impact first approach, and in our fundraising, for reasons of the sort of the new nature of what we're going into, as well as our emphasis on impact first. We've been quite cautious and conservative in what we were targeting in terms of returns. But that said, since we have actually been investing, the enterprises that we found are sort of probably more along the lines of the promise that Ben has just been talking about, where the returns are higher than possibly we had been prepared to share or forecast. So impact first is certainly our starting point, but what we're finding is actually there's real opportunity out there. Will it be the level that a VC wants? Probably not, and we need to be realistic about that. But that's not the sole objective of what we're doing.
Yeah. Thank you. That's really good. Actually, Allan, I'd really like to bring you back in here. Do you principally take equity positions, or is debt also part of your approach? And where do you focus on that impact first, finance first spectrum?
Well, certainly we're looking for impact. I mean, we're a foundation, so that's what we're created for, is to create impact. So that's the position we take. Regarding equity and debt, I suppose I would get 10 approaches for every one, 10 equity to every one debt. So there's a great demand out there for equity in that startup phase of some really new and wonderful ideas. Part of the challenges that you have as a foundation is that you've got to deliver 5% of our corpus in grant making every year. So we need cash to do that. So therefore, we've got to monitor the amount of equity positions we take, because more often than not, they don't generate any cash for quite some years, irrelevant of what that impact is. So that limits the amount of capacity that we've got to do equity investments. So therefore, we are always looking for some debt instrument that would make sense, that can give us a coupon rate that's going to enable us to hit our goals when it comes to the 5% grant making.
That's really helpful, I think, Allan. That's a really good point for us to pick up on, and it ties into Ben's comment here about patient capital and the need for patient capital as well, particularly in this startup phase that so many social enterprises are going through. But there are clearly opportunities emerging for debt more and more. So just let's come around. Does from a foundation perspective, does your investment policy statement have specific clauses in relation to impact investments and your requirements in relation to those?
Yes, we do. And we're a family foundation, so we can be flexible and break the rules a little from time to time when we need to. I do appreciate the challenge that happens with larger foundations when they're coming to these types of decisions, because if you're an employee for a foundation, a CEO or an investment officer, you're going to take quite a conservative view, because you're paid to be responsibly managing the funds for the original family that has put the foundation together. So, having a conservative lens on what you're looking at there and ensuring that you manage your money responsibly does put a challenge on some of those larger foundations. Smaller family foundations can certainly be far more innovative if the existing family are the trustees.
I think that's a good point, Allan, and it draws out, often we talk about trusts and foundations, as a bucket, but actually there's a real variety of different types of trusts and foundations here, and in fact many non-profits have their own endowments as well here. So we need to understand that there's a spectrum, and the way in which people will approach this will be driven partly by where along that spectrum they are, but that the investment policy statement is a really helpful element of that picture, I think. I think it's useful, just while we're touching on governance here, to just talk about boards and investment committees. And for each of you, have you upskilled your boards and your board members along this journey? Have you brought in specific people to help you do that. So I might start with you, Ben, and then just pick that up.
Yeah, I mean, from our perspective, I mean, we have a board and 3 committees in our governance structure. On that board includes multiple impact investors who have invested in ATEC. And it's pretty common as you go through rounds that one of the clauses negotiated into that is a board seat as well. So that's pretty common. And I think if you do that structured well, that can bring a lot of value to the table, because ideally that investor is not just bringing capital, but opportunity and networks into the mix as well. So you want to build that relationship to move through multiple sort of layers from there. I think from our perspective, that kind of is what we're looking for from a board perspective as well, is to very much bring people to the table that can bring multiple skills or opportunities into the mix, because we are operating in complex environments and in tricky situations, etc. So being able to understand that and really utilize some of that best practice experience and be able to adapt that into the sort of emerging markets in which we work, and having investors who can sort of come along on that journey with us as well. I mean, we have a whole range. We have institutional investors out of Europe through to family offices in Australia who have invested in ATEC. So yeah, being able to get everyone on the same page. And I think that values alignment is really important in that situation more than anything else.
Thanks, Ben. Simon, what have you done as you've brought this new fund in terms of governance and in terms of the people on your boards and your committees?
Yeah, it's been a bit of a journey for us. Impact investment's not the usual terrain for a charity board. Our starting place was we did have some board members who were very familiar with the financial services sector. So we had some really good experience on the board to help us get going. Then as we got to implementation phase, we set up a subsidiary of Save the Children Australia, which is another charity that acts as the trustee for our fund. So there's a board of that trustee company. It is made up of independents and a couple of members of our main board. So we've brought in some different voices and with different skill sets. We've also then got an investment committee, which is a broader group, again, with lots of external voices. What's been really exciting is the mix of the investment discipline that the externals have brought in with the implementation experience that Save the Children has. And rather than having the investment experts having to apply their governance skills into the charitable space, they're able to really bring their day-to-day experience and mesh it in with the stuff that we know about. And it's really, yeah, that's actually really quite an exciting discussion to be a part of. It is also bringing different disciplines into the charity. So it's made me a better charity lawyer, absolutely. It's helping us pollinate also different skills into our traditional charity operating environment.
Thanks, Simon. That's useful for us to understand, and the evolution of these skills coming in, I think, is really helpful to understand that these investors don't just bring capital. And I think, Allan, that's a really great point to bring you back into this and talk a little bit about your own kind of bringing the board and your investment committee along on this journey too. And perhaps, Allan, you could touch on your advisors as well and bringing them along on the journey.
Well, so we have a family office structure, which means we've got someone, this is the independent voice on the foundation that can apply the investment lens over what we do and give us guidance and dampen down the enthusiasm of the entrepreneur leader to stop making as many venture investments and look at a bit more sensible, reliable income producing investments. So that's the ongoing tussle between the founder entrepreneur background and recognizing that risk management is an important part of what we do here for protecting our corporates. So, but no, I'm fortunate to have a good range of contacts because of my involvement with Philanthropy Australia and the board there, that I made a lot of contacts that have got respected advisors in the space, and they're always a good resource pool to tap into. And I'm quite frank to be able to step outside the normal realms to look at where I can get advice that's going to be sensible and another perspective on it to ensure we have a balanced view of this.
Yeah, that as you said, that balanced view is critical here, and getting the big perspective. Let's just talk about the changes. I'm conscious of our time, and I know we need to give some people an opportunity to ask some questions, but for each of you, what changes have you seen in the market? And I'll start with you again, Allan. What changes have you seen in the impact investing market? And where are those spaces that you think there's still an opportunity to actually make some additional change and you'd like to see progress made over the next little while?
Well, I think the most significant one, I think, is just the size of the investment pool. I went to a G8 conference in Chicago on impact investing about 5 or 6 years ago. And the size of the market and what they're talking about there compared to what it is today is really quite significant. Government themselves are pulling some of the levers to drive that. An example of that was in France. If you are an employer where you've got over 50 staff members, then your staff members' superannuation must be offered a solidarity fund. A solidarity fund is where 90% of the asset pool gets invested in traditional stocks and shares and real estate, but 10% must go into impact investing. So, and they had 1 million take up in the first year when it was launched. So government itself can play some levers here to open up the marketplace for us and to be able to get more superannuation companies, which like hospitals and teachers and nursing, those caring communities want their retirement funds invested in something that's going to be more aligned to the values that they hold to be true. So those larger super funds need to start shifting, and we've got to find good product opportunities to match into those desires to have that reflected value tied up with their retirement funds. So I see there's wonderful opportunities ahead of us.
Excellent, thanks, Allan. Ben, let's come to you. What have you seen in your time, and what would you like to see over the next little while in terms of change?
Yeah, I think it's can bring an interesting perspective, because I was involved in impact investment in Australia for a few years directly in Australia, and then sort of 6 odd years ago when we started ATEC, I've then involved a lot of internationally. If I'm to give a fairly honest assessment, I think Australia is moving forward, but it's moving forward fairly slowly in this space compared to the speed at which things are moving forward internationally, particularly compared to Europe. I think Europe is very much the leader in impact investment, and I think America's starting to really click into gear there, and I think Australia's probably a little bit behind where the US is, but hopefully it starts to move forward. I think there's probably just a couple of things holding back the Australian impact investment sector. I think number one, we've probably been overly domestically focused so far. So it's really great to hear Simon and the Save the Children Fund, for example, coming along. I've started to look outside our own backyard at impact investing opportunities. I mean, if you look at the deals that are going on in Asia and Africa around both equity and debt, we're getting up into the tens and hundreds of millions of dollars. And these are happening frequently now. And I think Australia is quite a player in financial markets, and we're missing a lot of opportunities to get there. I think most of the weight in Australia has probably been pulled more at the sort of family office and foundation level traditionally. We've got a few great impact investors on an equity side that have come to us through family, but it's more of that family office who are a bit more sort of willing to take risks as such. And we've also had some crowdfunding from a debt perspective as well through Red Hat Impact and Led for Good. So that's starting to come in. But I think there's still quite a gap, and it's great to hear, I think, Simon's trailblazing a bit there of some more institutional options, particularly for, say, family offices or high net worths or other organizations to be able to, that have a specific mandate of looking at investing outside of Australia from an impact investment perspective. If we look at Europe, for example, you're seeing $70 million, $100, $200 million funds now that have mandates to invest into Africa and Asia, and they're aggregating, pulling together that funding as well. So I think that's an opportunity that we really need to start moving forward in Australia. The other one that's quite interesting, I think there's quite often this tension, and Allan touched on this earlier, around seeing a lot more equity opportunities, but the equity sort of typical investment structure is sometimes hard to work for be it foundations or family offices, whatever it may be. There is an emerging sort of capital class, I suppose you'd call it, around venture debt, which is kind of halfway between your traditional debt and a standard equity investment. And we're starting to see quite a few larger investors keen on this, because it has a very clear sort of return structure and exit structure for investors to be able to come in with. So particularly an impact investment where potentially some of that funds is institutional, it seems to work quite well from an investor perspective. The question, and I mean, it's very similar, Silicon Valley Bank, for example, is sort of ones that trailblaze this in Silicon Valley, the structure. We're still trying to work out ourselves, okay, how does that fit in the mix compared to equity? Because effectively that has priority over equity when it comes to payout as well. So I think there's still probably some questions to ask around how does that fit in the mix in an effective way that doesn't scare off or deprioritize straight up equity investors. But yeah, it's an interesting structure that no one was talking about really in impact investment 18 months ago, and suddenly we're seeing it coming up left, right, and centre.
All right, that's really good, Ben. It's certainly an evolving market, you know, and you're right in terms of opportunities in Australia. And Simon, perhaps good to bring you in here now and just talk about what you've seen change and what you'd like to see change over the next little while as well.
So it's a bit of a funny story from the Save the Children side, acknowledging the bigger volumes of funds and more mature market in Europe, and perhaps Australia lagging behind. For our organisation, the work that we've done in Australia has now been seen by the broader organisation, and we're pushing into Europe. So we've just set up or are setting up a new venture, Save the Children Global Ventures, which is going to expand the impact investment activities that we started in Australia into a bigger Save the Children platform, which we're really excited about. But it's moving into those more mature spaces. We're working closely with other NGOs, UNICEF Impact Investment Team in New York, CARE have an impact investment facility. Mercy Corps have a facility that's been around for quite a few years. So what we're sort of starting to gather is a little bit of mass around how this stuff works, and hopefully in the near future this sort of congeals a bit to be a recognisable space where this is where you can go for deep impact, quality impact investment. So the thing that I think we're missing at the moment is if you're an investor, how do you find the things that
that's a really good
impact?
That's a really good segue for me, Simon, because that's actually one of the questions that's come up for us here, and I'm interested in your thoughts, and Ben and Allan as well, is would an intermediary platform assist to facilitate investors to reduce risk and share and manage due diligence as well? So just if each of you would like to comment on that.
Yes, we set that some form of platform in Australia. I think it's been called for in government submissions by various parties. This is something that would assist, something where you could mark the different options that are available, which we just currently don't have in Australia.
Yeah, great. Ben, Allan, comments from you?
Oh, I think anything at all that's going to increase transparency and manage risk will attract more players into the territory. So, you know, I'd be all for it.
Thank you. Ben?
Yeah, I think definitely it can. I think it depends a bit on where you're looking. I'm not as familiar with the Australian sort of domestic area these days. So, but I think probably it's a really good option. Internationally, I think there's also, yes, and there's also some good options out there as well, such as Impact Investment Exchange in Singapore have a pretty good platform for sharing that. TONIC, TONIC is another international platform for impact investing. So there are some options out there. They're not specifically focused in Australia, but they are sort of global options that people can tap into as well.
Thanks, Ben. That's really good. You're right that these platforms continue to emerge. What we're lacking is perhaps something here in Australia specifically to sort of charge the market here. I'm really conscious of our time. It's been a fascinating discussion, and I know we could continue all morning on this. So I really thank each of our panelists. Having the different perspectives and the different journeys that you've been on is a really, really useful insight for us all. I think we would all encourage exploring more deeply these opportunities. And our next 2 panel sessions, Clay will talk to the journey that we've been on here a little bit. And then Stuart's going to unpack some other elements. I am just going to do a blatant piece of advertising here for a moment. So at Good Wolf, we are really working to support trusts and foundations and non-profits to align their capital with their charitable purposes. We have an Endowments for Impact program and a series of workshops. Victoria is kicking off later this month. We're kicking off series in New South Wales and Queensland soon after. But a whole program around this, not just workshops, but reports on key issues, baseline information about where we're at, helping to identify the opportunities that are out there and the tools and techniques that trusts and foundations can use. So if you're interested in any of those things, please don't hesitate to reach out to us at Good Wolf, but also encourage you to work through AIDN as well in this. That's it for us this morning. So I'm going to just again thank all of our panelists and thank AIDN and Stuart at Good Business Foundation for making today possible, and encourage you all to join the next 2 sessions with Clay and Stuart. Thank you, everybody.